You log into a stock screener for the very first time, type in a ticker symbol, and immediately get hit with a wall of numbers. Staring at 72 different metrics on a single screen is paralyzing when you don't know which specific data points actually drive long-term value. But you don't need a finance degree to cut through the noise. You just need a strict 6-step checklist for fundamental analysis. Before we start, let's set a ground rule. We are completely ignoring short-term chart reading, price patterns, and day trading speculation. We are looking for long-term stability. Shifting your focus to long-term fundamentals moves you past the anxiety of daily price swings. You are evaluating the underlying strength and endurance of the business itself. Step 1 is simple. Pick a single company whose products you already use and interact with on a daily basis. If you own an iPhone, start with Apple. Step 2 requires a business owner perspective. Every share represents a tangible stake in the company's physical operations and long-term success. The legendary investor Warren Buffett has a very specific way of framing this. He argues that buying a stock should be evaluated exactly like buying a physical farm. You calculate the expected cash flow from the crops and subtract the operating costs to run the tractors. Knowing how a company physically operates and generates everyday utility provides a reliable foundation for keeping your head straight when the market gets volatile. Step 3 is where we verify that company's health by checking the holy trinity of accounting: the balance sheet, the income statement, and the cash flow statement. You could dig through the SEC's Edgar database for these, but it's often too complex for beginners. Use Yahoo Finance for a cleaner layout. Start on the balance sheet. Divide current assets by current liabilities for your current ratio. Above 1.0 covers short-term debts. On the income statement, net income divided by total revenue is profit margin. Look for 10%. Finally, verify free cash flow grows yearly. If a company is actively losing money and shows no profits, walk away. Unprofitable, speculative growth companies do not fit this specific strategy. While Amazon famously operated at a loss for years before turning a profit, they are the exception. Most unprofitable startups simply run out of cash and vanish. These 3 financial documents cut through public relations and media hype. They expose the plain math of whether a company is truly financially viable. Step 4 involves checking valuation metrics. Identifying a healthy company is the first step, but you still need to determine if its current stock price is fair. Look up the price-to-earnings, or PE ratio, on your screener. This number tells you exactly how many dollars investors are currently paying for every $1 of the company's earnings. Remember the rule of comparison. You must evaluate PE ratios against companies in the exact same industry. Tech companies should be compared to other tech firms, not to grocery retailers. If the company you're evaluating is heavily focused on growth and currently unprofitable, use the price-to-sales ratio instead to see how its valuation stacks up against its peers. Even a healthy company with high revenues can be a poor investment if you purchase the shares at an overvalued price. Step 5 moves past the spreadsheets so we can vet the company's management team for stability. Research the CEO's background. Look at the experience section of their professional profile to verify they have a long, stable tenure and understand the specific mechanics of that business. Step 6 is identifying the company's competitive advantage, the economic moat that protects its market share. This moat could be exclusive pharmaceutical patents, unbeatable global branding like Coca-Cola, or visionary technological innovation like what Elon Musk brings to Tesla. Stable leadership combined with a distinct economic moat creates a defensive shield against market disruptors and economic downturns. Once you complete all 6 steps, you have a concrete, logically sound answer on whether that company deserves a place in your portfolio. To manage risk, repeat this exact process across multiple different sectors. This builds a diversified portfolio that isn't reliant on a single industry. If analyzing individual companies feels too labor-intensive, you can choose to buy broad index funds to automatically capture the growth of the entire market. Mastering this checklist replaces market anxiety with a repeatable system. You are no longer reacting to price swings. You are making decisions based on data you actually understand.